I'm joined by George Feiger, Chief Executive of Contango Capital Advisors, where he helps oversee about $3.5 billion in assets. George, good to have you back on the program. So it looks like Obama might be willing to sign one of these short-term deals, but what about the debt issue itself? How are you investing ahead of this decision?
Well, you've got to look at everything that's happening. People tend to focus on one problem at a time. The last few days, certainly here in the U.S., people have looked at the debt limit and the negotiations. We, however, are in an unprecedented situation. There are three significant problematic events happening simultaneously. The U.S. debt ceiling problem, the enormous crisis in the Eurozone, and what you just mentioned, rising inflation throughout most emerging markets, not just in Asia, but you can go to Turkey, you can go to Brazil, which is causing government tightening and slowing growth. So everywhere in the world you look, you find, in effect, politically induced problems.
Yeah, so where do you run for safety then?
This is a major investment problem.
Yeah, it is a major investment problem.
Where do we go for safety?
Where do you go to? Yeah.
Well, what you have to do is decide unless you're a psychic, you have to decide that you're going to take the least worst path. So when you evaluate these crises, as we look at it, the European situation is the worst. There isn't one country there. There are squabbling sovereigns, and it's highly unlikely they will find a very effective solution. At a minimum, you're going to need to recapitalize a lot of banks, which will cause financial problems. At worst, countries will drop out of the euro. If you look at emerging markets, in the long run, no one is more bullish on emerging markets than we are, but we're seeing the growth cycle slow down for a while. That's going to affect stock prices even more than it has. It's going to drive down the price of raw materials probably, and the resource-sensitive currencies, the Australian dollar, the Canadian dollar. So the US, where we're going to get some sort of muddling compromise, is probably the least bad place to be. And so what we're doing right now is focusing more on the U.S., on quality equities, on short-duration debt, and we're waiting for a bounce in the dollar. And if we can get a bounce in the dollar, then we'll start to buy things.
That's interesting. So then it becomes, I guess, cheaper elsewhere in the world. Well, let me talk to you about earnings season so far, because some are saying this is getting lost in the mix. You know, you have pretty good numbers coming from Intel. You have Apple, of course, again, surpassing market expectations. IBM doing pretty well. So aren't people focusing on the wrong things? Take a look at the numbers themselves for the corporates.
Yes, but the bellwether, the leading indicator of corporates is banks, because banks are sensitive to the whole economy. And the banking system is, while it's recovered for some time, remains quite troubled. And if you think about what's really going on here, you have all the signs of a slowing economy. The problem with earnings coming out of a recession is that they're not what I would call representative. Companies have squeezed every bit of efficiency they can. That rate of efficiency growth has slowed. So we are still fundamentally seeing corporate earnings and corporate values driven by these political issues of what will happen to the government, of what will happen to interest rates. Backward looking doesn't work at a time like this.
Okay, well, you're reluctant to make big bets. Those are your words, George. So I guess, what's the allocation right now of your portfolio? What are you doing with your cash?
We are in blue chip equities. We are in high quality corporate credits. With very short duration. The duration of all the portfolios is under 3 years, because our fear is the long end of the yield curve is going to rise, and that's going to cause significant capital losses. We've increased to a small extent our investment in gold. I'm not a gold bug, but gold is a political vote that governments aren't working, and they certainly aren't working now. So it's conservative equity, conservative fixed income, a bit more cash than usual, a little more gold, and waiting for an opportunity to diversify into things that have fallen in value. It's just a time to be cautious and to wait.
Okay. Well, thank you for your insights this morning, George. Nice to see you. George Feiger, CEO of Contango Capital Advisors.